Hi everyone, so thanks so much for being here tonight and also having me. Obviously sad that Maria couldn't be here because of the C word, but hopefully I can not be too shabby a replacement and hopefully talk about something interesting for the next 15 minutes or so. Going to try and strike a bit of a balance between kind of my personal story and the funds that I run and how I kind of got into, that role, and especially, the kind of environment that I work in, but also why running those types of funds and investing flexibly in general, whether that be, sophisticated clients in the funds that kind of we work on the desk, or whether it be retail investors like yourselves. A lot of the funds that we actually run here at M&G are available on platforms like Hargreaves Lansdown and also other investment managers as well, the Schroders, the Fidelities of the world. So many of those funds you think are inaccessible to you, as well as individual stocks and shares, but actually you can access them like any other client through those kinds of platforms. So we'll kind of talk a bit more about the ones that I work on, but also why those kinds of strategies in general can help both, personal portfolios as well as, what we help kind of our clients try and achieve. As we mentioned, I'll try and also touch on a bit about ESG. So for those of you who don't know, it stands for environmental, social governance. So that kind of more moral and ethical lens to investing, and how that's changed the landscape of how we think about investing, and also what clients are demanding, and kind of how that's affected the things that I work on kind of day to day as well. Oh, there we go. So I'll start with just a little bit about me and kind of what I do and how I got there. So I joined M&G in 2018 as a investment graduate. I then rotated around the business for about a year, and a lot of people ask, you're quite young for what you do, what's, I don't want to say the secret or anything, but honestly the story is really quite simple, in that when I rolled off the grad scheme, there happened to be a job opening in the fixed income team for a junior fund manager. Never in the world thought that I would get that role, having just rolled off the grad scheme, and I don't know if that's something that we're naturally a bit underconfident in this kind of industry, but didn't think, because of my experience, that I had any chance of getting it. Went through quite a rigorous recruitment process and got the job. So obviously then went and joined that team. So I did that for about a year and a bit, and then so that was as a junior macro fund manager, so working on a variety of different strategies. And then in January last year, so 2021, was made lead manager, so lead fund manager on the global government bond fund. So that means that we invest in predominantly global government bonds, which is obviously so relevant at the moment because naturally a lot of the world's kind of news narrative is being driven by geopolitics and central banks and governments can't issue shares, they only issue bonds, right? So the main way that that impacts markets is through the debt market. So running that kind of fund that invests in fixed income and bonds, and especially government bonds, is quite difficult at the moment, but also interesting in kind of its own right. Also deputise on a different strategy called the Global Macro Bond Fund. So that is one of our most flexible strategies kind of on the desk. So that can invest in government bonds. It can also invest in corporate bonds. We do currencies. We do kind of ABS and securities that are backed by more physical assets. We do a lot of derivatives as well. So very, very flexible and kind of go anywhere fund. So really kind of interesting way to express your kind of economic views. Yeah, that's more or less it really. I'd say I had a reasonably conventional route into the kind of industry. I did an economics degree at Birmingham, and then did a summer internship my penultimate year, and then joined on the graduate scheme. So yeah, rest is history, I suppose. So yes, as we said, obviously, if you've kind of worked out the timeline, so joined the team in 2019. We then obviously went into lockdown in February 2020 or March 2020. So it's been a very kind of volatile start to the job. It's been quite an interesting thing in that actually I think COVID in a really strange way actually was quite beneficial to me as a investor, because when you're in the office, often you can kind of learn from osmosis and be quite babysat in terms of sitting between people and, getting that kind of daily reassurance. Whereas when everyone had to go and work from home, I didn't really get that. And so it was actually quite a good opportunity to kind of step up, and I had to, dive into the deep end, I suppose. So in a strange way, even though it was a, really worrying time and we didn't really know what was going to happen, it was actually probably for me something that actually helped my very steep learning curve, because I had to be very proactive in that time. But so as you can see, so this chart is the MOVE index. This is the interest rate volatility index. This is basically giving you some kind of indication of the volatility of bond markets. So as you can see, we haven't really had these kinds of spikes since, actually, when this chart goes further back, probably since the global financial crisis of 2008. So now we're seeing multiple spikes, obviously through the COVID pandemic, as well as what we're seeing in the horrible situation at the moment in Eastern Europe. So from kind of a fund management perspective, as I joined the desk in late 2019, it's obviously been a very volatile time. It's been a time of learning. We talk a lot about the kind of different contexts on the desk, and there are lots of people on the desk that have a lot more experience and have worked through times of relative calmness and relative normality in markets, and that's quite interesting because my normal is not calm. So it's been quite a learning experience, but in many ways it is I did an economics degree, so I'm very kind of focused on that kind of macroeconomic outlook, and those are the things that interest me in terms of interest rates and inflation, and actually those dynamics being so kind of interlinked and volatile. It's actually been a real test in many ways. Okay, yeah, the key word inflation. So as we've already talked about, in terms of having to sadly go and fill up your petrol tank is really quite painful at the moment. But as we've said, the same thing, that a lot of people on my desk haven't seen a very volatile environment in terms of bond markets in general. A lot of them haven't really seen inflationary environments either. So this chart is from 1970. So actually the last time we had a real spike in kind of US CPI was in the late 70s, 80s. So since then it's been pretty muted. And now actually this slide is actually slightly outdated if you look at recent numbers because of what's happening to oil prices. So it's actually, to me, I've almost only seen kind of inflationary environments, because once we had the COVID pandemic begin to ease off, we expected a big resurgence in demand. We had central banks easing monetary policy, very aggressively. So you expected inflation to be pushed higher from that. So, and then we also have to look at what central banks are doing kind of day to day. And a lot of that inflation narrative has been very pushed by central banks. And it's, something that we have to look at a lot in fixed income portfolios. And I think there's a little bit of a misconception that fixed income portfolios are very vulnerable to inflation, because naturally, if you have higher inflation, then you are eroding away the value of your current income. So you're eroding away the value of your current debt that you're lending out, essentially. So people assume that fixed income investments are actually very, very vulnerable to inflation. We actually find that the importance of a dynamic portfolio, which I'll talk a little bit more about the details of that in a second, that we can actually protect very heavily through things like inflation-linked bonds, or things like floating rate notes. So that's a bond that's issued with coupons that match rising interest rates. So you can actually be protected in many, many ways. We also look a lot at different markets, so the differences between developed markets and emerging markets, for example, and the different regimes that you see there. And obviously inflation has been different kind of across the globe. It seems to be a bit of a global phenomenon, but it has gripped different regions in different ways. And so you also look at the central bank reactions to that, and how many emerging markets have actually been ahead of the hiking cycle. So they're actually reacting to inflation quicker than perhaps developed markets are at the moment. So this is just kind of a summary slide of the kind of strategies that I run, and also a way to maybe think about investing in general. So it looks quite messy, but I'll just kind of talk it through. So what we look at kind of on the desk is you have a difference between top-down investing and bottom-up investing. And what that means is that top-down is you're kind of starting with those big macro themes. You're starting with, what do I think about, inflation? What do I think about growth? What do I think about geopolitics and things like that, and you start with those big top-down themes. And that may also be something where top-down come in many different forms. You may also be looking at it in terms of regions. Do I prefer UK or US or whatever? And that's the kind of thing that if you're running also a personal portfolio, you can split things up that way from that top-down perspective. What we then do is try and combine that also with kind of bottom-up. So what that means is looking more on a fundamental basis, so looking at individual corporates, individual governments, individual currencies. So where this is kind of going from the bigger picture themes and then the way that we allocate and then the kind of shorter term stuff. That's basically just trying to say that we are trying to combine that top down and bottom up. And I always think even in my personal portfolio, that's also a large way that I will allocate between different things. So I'll have overarching views of which regions or which areas of the market am I more constructive on. And then you might look at that bottom up in terms of which particular funds do I like, which particular stocks do I like, which particular vehicles do I want to express that view through. So that's essentially what we're also trying to do in the funds that I run. This is also just an idea of kind of the levers that we can pull. So ignore this for the most part in terms of what the different charts are saying, but it basically just kind of shows the flexibility that we do have, which is a way that we can both add risk or mitigate risk in these kind of volatile environments. So the top left, as I said, is kind of government bonds and cash. So that's what you would consider your safer investments, so the ways that you would perhaps be mitigating your risk. So at the moment we're seeing those. They are quite volatile because of central banks as well, but in general, when you get negative news flow, you tend to see quite a large flight to quality. So that means a flight to the safer assets. So those kinds of net government bonds. So you can see going into the pandemic in 2020, early 2020, we had a massive amount of those because that was us trying to mitigate that particular risk. And then some of the other levers as well are things that we can pull up or down to try and take exposure to the areas that we believe are either have value or are too expensive and therefore want to take that off, etc. The only other thing I'll quickly touch on, because I'm nervous that I'm probably running out of time, is obviously ESG. So you can see this in terms of, okay, we can kind of allocate where we want, but is that what our clients want? Do they want us to allocate to anything that has value? And actually the question is, can we actually make a difference in terms of trying to allocate to those companies or to those governments that we believe actually have some kind of positive influence on the world? And so it's a much easier thing to do in the corporate world. So in terms of stocks or in terms of individual corporate bonds, that's quite an easier thing to do because you can engage with corporates. The thing to think about is actually on a sovereign level in terms of, sovereign policies or, kind of climate targets or whatever on a global level. Can you actually engage or influence a sovereign? So that's a much harder question and something that, we need to consider very heavily and something we're trying to tackle in both government bond funds and also blended funds like this. So I'll stop there because I could talk for ages about ESG, but I won't. But thanks for having me and I hope you enjoy the rest of the evening.
I'm aware that some of you are probably complete beginners to investing and some of you are incredibly experienced. Can I just ask, because there are no daft questions here tonight, that's the whole point of tonight's event, how many of you know what a fund is? How many of you would like to know just a quick explanation of what a fund is, just in case people here are just thinking, either I don't know, or I'm not quite sure, or I'd like to just make sure I know.
Yeah, sure, of course. And I do apologise if that is the case that you haven't understood anything I've just said over the last 15 minutes. I'm happy to break that down maybe another time. So a fund is basically a collection of investments. It can be either a equity fund, so that would be a fund that invests purely in stocks, or it could be a bond fund, so a fund that, as I do, invests purely in bonds, or also can be currencies and flexible and things like us. Some of them are also multi-asset, whereby you could do stocks and bonds, for example, or real estate and all sorts of things. But the point of a fund is that, imagine you as an individual have £100. You can probably, imagine a stock or a bond is £10 each. You can buy 10 of those, right? You can only diversify your portfolio 10 ways. If you were to put that £100 in a fund, that fund accumulates all of that income from multiple sources. That fund can then go and buy 100 different stocks or bonds. So that means that you actually then have exposure to 100 different things without having to go and buy them individually yourself. So what it does is it allows you to get broader diversification without having to buy the individual costs yourself. Also not having to incur those individual transaction costs yourself. You're just paying one particular fee, whether that be small or large, for whatever fund it is that you're buying, often not large nowadays. But you could also potentially buy, there's also a difference between active and passive. So if you were to buy an index fund, that means that you're buying a fund that directly tracks an index, so the S&P 500, for example, or the NASDAQ. So you're buying basically those indices that you see on TV a lot. If you're buying an active fund, you're buying a fund where someone is actively trying to beat that particular index or benchmark. So rather than follow the market, they're trying to pick the stocks or bonds that they believe will outperform. So in times of downturns, if you believe an index or the broader market is going to fall, you're probably going to want to be in an active fund where you hope that that fund manager can take advantage of those fluctuations in the market and pick those that will outperform. I hope that
and
helps.
boy, we're seeing a lot of volatility at the moment, and I'm always asked about, you know, how to make sure that you make your investments as safe as possible, because there's always risk. But it's always about making sure that you don't have all your eggs in one basket, and that's why diversification is really important.
Yeah.
I know a lot of women, you were talking about ESG, and yeah, we could talk about that for ages, but just a really quick one. If people here want to be sure that the investments that they're making chime with how they feel about the world, is there enough information out there at the moment for them to do that?
It's so hard. It's such a hard question because I'm not even sure there's enough information to help the regular person, man or woman, invest in general. So I think that, you know, the kind of moral lens you then put on it is something that I think is so important, but at the moment it feels like a bit of a nice to have. It feels like at the moment even the knowledge of where to invest your money to begin with is quite hard. The good thing is that because that is quite a large demand from clients, is that a lot of funds nowadays are being subject to regulation that requires them to be more ESG kind of compliant, and a lot of funds are launching new products that also have that ESG lens on them because they understand that that's what clients want. In terms of information, you know, I do think there are a lot of, you know, great networks and news sources, but to be honest, I think it's probably hand in hand with normal information, if that makes sense, and you have to probably look at the alternatives that are offered in terms of fund level and probably stock level as well. You know, and obviously news flow is a obvious in terms of, you know, renewable energy and which companies are trying to do good, but you also have to be aware of things like greenwashing, which is basically when companies try and make it seem like they're doing more good things than they are. So sometimes it does feel like a bit of a labyrinth to navigate through. I'm not sure that really helped to answer your question.
It did help, it really did. Ladies and gentlemen, Eva Sun-Wai.
Thank you.